WeWork started in 2010 with a bold vision: revolutionize the way people work. Founded by Adam Neumann and Miguel McKelvey, the company promised more than just office space. It offered vibrant, flexible workspaces designed to foster community, creativity, and collaboration. The idea was simple but powerful, and it quickly captured the attention of investors worldwide. By 2019, WeWork was valued at an astonishing $47 billion, one of the most expensive startups in the world. SoftBank's Vision Fund poured billions into the company, pushing its rapid global expansion. Offices opened in New York, London, Shanghai, and dozens of other cities. Modern designs, stylish interiors, free amenities, and networking events made WeWork locations highly attractive to startups, freelancers, and even big corporations. But behind the glossy marketing and soaring valuation, a dangerous reality was forming. WeWork's business model relied heavily on long-term leases for buildings, while revenue came from short-term memberships. On paper, this seems scalable, but in reality, it created a massive mismatch between liabilities and income. Any drop in occupancy could instantly turn profits into losses. Despite growing revenue, WeWork was burning cash at an alarming rate. Billions went into office build-outs, marketing, perks, and expansion. Yet profits remained elusive. Growth became the obsession, overshadowing the need for a sustainable business model. At the heart of the storm was CEO Adam Neumann, whose larger-than-life personality defined WeWork's culture. Inside the company, the work environment blended high energy with extreme risk. Extravagant parties, high salaries, and unusual perks created a sense of invincibility. But Neumann's personal dealings raised serious red flags. He leased his own properties back to the company, sold the trademark We to WeWork for $5.9 million, and spent company funds on $60 million Australian dollars private jet. SoftBank's massive funding fueled this growth, removing discipline and accountability. The company kept expanding aggressively, often without proper governance. Investors bought the vision rather than scrutinizing the numbers. The turning point came in 2019 when WeWork filed for an IPO for the first time. The company's financials were publicly disclosed, and the reality shocked investors. The filings revealed massive losses with no clear path to profitability, complex related party transactions tied to Neumann Wheat Corporate, governance and decision-making governance on long-term lease obligations. Public scrutiny immediately destroyed confidence. The $47 billion valuation collapsed, plummeting below $10 billion. Investor faith vanished almost overnight, forcing WeWork to withdraw its IPO. Adam Neumann was eventually forced to step down, taking a massive payout while employees faced layoffs and uncertainty. SoftBank's Vision Fund suffered losses estimated at $16 billion. By this point, it was clear rapid growth without fundamentals. Weak governance and overconfidence had turned a visionary company into a ticking time bomb. The real test for WeWork was just beginning. The next phase, the COVID-19 pandemic, would accelerate the collapse, pushing the company further into financial distress. After the failed IPO in 2019, WeWork's future became uncertain. The company had burned billions, lost investor confidence, and faced leadership turmoil. Adam Neumann had stepped down as CEO, but the structural problems inside the company remained. Expansion had been relentless, but profits were still nowhere in sight. SoftBank, the major backer, tried to stabilize operations, but the financial model itself was flawed. Then, in 2020, the COVID-19 pandemic hit, and the office rental industry was turned upside down. Suddenly, millions of employees around the world began working remotely. Demand for shared office spaces plummeted almost overnight. Buildings that were once buzzing with startups and freelancers now sat empty. The very core of WeWork's business model, renting out flexible office space, was in crisis. WeWork's obligations didn't shrink. Long-term leases remained active, and monthly payments to landlords continued. While income from memberships fell dramatically, the mismatch between revenue and liabilities became more dangerous than ever. Cash burn intensified, forcing the company to seek emergency funding to survive. SoftBank stepped in with billions in rescue financing, but the terms were strict. Management had to cut costs, slow expansion, and restructure lease obligations. Locations were closed, staff were laid off, and salaries reduced. WeWork, once seen as unstoppable, was now fighting just to stay afloat. Financial losses kept mounting. By the end of 2020, WeWork's valuation had fallen to just $2.9 billion, a fraction of its peak $47 billion estimate. Investors who had poured billions into the company were facing unprecedented losses, with SoftBank alone reportedly losing around $16 billion. Beyond finances, WeWork's reputation also suffered. The community-first branding was now overshadowed by headlines of bankruptcy risks, executive excess, and failed promises. Public trust, which had been a key part of the company's allure, was severely damaged. Meanwhile, the company attempted to restructure. New leadership focused on operational efficiency, renegotiating leases, reducing office space, and targeting corporate clients who could commit to long-term agreements. WeWork tried to pivot from rapid expansion to profitability, but the road was slow and uncertain. The pandemic highlighted a harsh truth. WeWork had underestimated the fragility of its model. A business based on flexible memberships and high fixed costs is highly vulnerable during global crises. The dream of revolutionizing the way people work collided with economic reality. Despite these challenges, WeWork continued to operate. Some locations remained open, catering to essential workers and companies gradually returning to offices. The company sought to prove that with disciplined management, cost control, and strategic focus, it could survive. Yet, the warning signs were clear. Hypergrowth without profits, poor governance, and overvalued hype had brought the company to the brink. The pandemic only accelerated a collapse that was inevitable, given the mismatch between its ambitions and financial reality. The WeWork saga became more than just a story about a startup. It was a global lesson on corporate governance, financial discipline, and the dangers of valuing vision over fundamentals. By 2021, WeWork's survival depended not on hype, but on its ability to finally focus on sustainable operations and profitability. By 2023, the inevitable finally arrived. Years of reckless expansion, poor governance, and financial mismanagement had left WeWork teetering on the edge. The company, once valued at a staggering $47 billion, was filing for Chapter 11 bankruptcy. Investors, employees, and the entire tech world were shocked. What was once a symbol of innovation had become a cautionary tale of hype gone wrong. SoftBank, which had poured billions into the company, faced massive losses, estimated at $16 billion, making this one of the most expensive startup failures in history. Adam Neumann, the founder who once embodied WeWork's audacious vision, had stepped away, cashing out with a controversial payout, leaving the company and its employees to deal with the aftermath. The bankruptcy revealed how fragile the company truly was. Despite operating in over 100 cities globally, WeWork's financial structure was unsustainable. Long-term lease obligations, short-term revenue streams, and continued cash burn had created a ticking time bomb that finally exploded. The lessons were clear and global. Hype does not equal value. Investors had bought the vision of a tech-driven revolution in work rather than solid fundamentals. The company's valuation without profitability is a bubble waiting to burst. Corporate governance is non-negotiable. Leadership failures, conflicts of interest, and a lack of oversight allowed billions to be spent without accountability. Rapid growth can kill a company. Expansion without sustainability may look impressive in headlines, but it can destroy a business faster than any external crisis. External shocks amplify weaknesses. The COVID-19 pandemic exposed WeWork's reliance on crowded offices, showing how fragile, asset-heavy, les-dependent models are during global crises. WeWork's story also transformed the co-working and startup world. Investors became far more cautious, scrutinizing valuations, cash burn, and leadership transparency. Many emerging startups learned the hard way. Vision alone cannot replace discipline, strategy, and governance. Yet despite the bankruptcy, WeWork still exists today in a smaller, restructured form. Offices remain open, corporate clients return, and some communities still thrive. It is no longer the headline-grabbing unicorn, but a reminder of what can happen when ambition overtakes reality. For the global business world, WeWork is now a case study. A company that promised to change the world, burned billions in the process, and became a stark warning about unchecked growth. If you want to learn more about the rise and fall of the world's most fascinating companies, and uncover shocking stories behind billion-dollar collapses? Make sure to subscribe to Bees Decoded. Don't miss out on insights that investors, entrepreneurs, and business enthusiasts need to know.